So yes, 2023, if you look at the year, then it has been dominated by the macro scenario. The stock markets have been completely driven by macroeconomics. And into 2024, we feel that macro will still be important. However, I would like to state that we are not in the soft landing camp for 2024. We do believe that there is going to be a recession because monetary policy, the aggressive monetary policy tightening that we have seen, it works with a lag. And we expect the impact of it to show next year. We've already seen the two strong pillars of the economy which held up the economy in 2023, consumer spending and the strong jobs market, both gradually starting to slow down. And we expect this to further happen in 2024. Therefore, we do expect that somewhere during the first half of 2024, we are likely to see a recession. However, we feel that this recession, it was very anticipated. It was the most anticipated recession for 2023. It did not happen. And now people are thinking more about soft landing. So we think it is going to be more of a clearing event for the markets. And once it hits, actually, people will start talking about Fed action, about, looser monetary policy, rate cuts, which should actually be good for equities. And at that point, we would be very positive on sectors such as cyclicals, industrials.
Yeah, no, you mentioned a lot there, so I just want to go back to what you were saying and pick up about your comments regarding the U.S. recession. And I think it is important that we dwell on this topic because many people now, rightly, as you said, have moved away from this concept of hard landing to a soft landing. The rates rally that we've seen is quite remarkable the last couple of weeks. And yet the question that I'm asking is, if rates are rallying because they expect, or the market participants expect, the Fed to start cutting interest rates, is that a good thing or actually potentially a bad thing? And if it is a bad thing, why are stock markets doing so well?
So yeah, this is like a double-edged question. It's very interesting. So, markets are pricing in about 125 bips of rate cuts next year. We do feel this is a bit excessive. We do expect rate cuts next year, but we feel the quantum may be slightly lower. And the rate cuts will happen if the economic data is really bad or if inflation really comes under control. Now, these are two different things. If the economic data is really bad, that is not very good for the markets. And in that case, this is a premature celebration. But however, if the rate cuts happen because inflation comes within the targeted territory for the Fed, then that is a good thing for the markets. And that is something that, deserves the stock market applaud.
Yeah, it's a very fine balance, to your point. Do you have a view on which central bank around the world is going to be cutting more in 2024?
I think I am in line with consensus here. I do expect that it will be the ECB which is going to cut more, and they will be also among the first ones to cut. We've seen that, inflation data in Europe has been weaker as compared to other geographies. And then, of course, we will have the Fed and, the Bank of England following soon.
Interesting. Okay, so earlier on you started to talk about some of the sectors that you like. So let's go back to that. Talk to me about where you want to be positioned in 2024 if your thesis actually does play out.
Yeah, so for 2024, we feel that initially we might start with a lukewarm market, and then, as economic data weakens and as, we see the recession coming in, the markets might be weak. But once the recession hits and we talk about rate cuts and the rate cuts actually start happening, the market should start to rebound, and the second half should be very good for the stock market. And in this scenario, the sectors where we would like to be positioned will be industrials, cyclicals, consumer discretionary, and also certain rate-sensitive sectors.